All right, let's quickly give you the markets update now. Global economic developments are expected to direct world market activity in this new trading week. Analysts say U.S. Consumer Price Inflation data will help give a hint on how much the Federal Reserve will be raising the interest rates by. Meanwhile, oil is seeing continued advances due to increased demand. These are the prospects with the opening of China's borders. Portfolio manager at Rand Swiss is Gary Booysen, and he joins us now for this conversation. Gary, good morning to you and Happy New Year. What's expected to dominate the global market activity in this new trading week, given the recent 10-cent global developments, including better than expected U.S. jobs data, inflation easing in Europe?
So, yeah, you've mentioned a lot of the key drivers already. As you said, it's going to be down to the economic calendar. Yeah, I think the Fed is still driving most of the action in financial markets. And as you said, an interesting jobs number on Friday. We had a very, very strong payrolls print. So the non-farm payroll number came in at 223,000 jobs added versus 200,000. We also saw a surprise where the unemployment rate actually dropped. They were expecting it to move out to 3.7% unemployment. It actually moved down to 3.5% unemployment. Yet the market is very, very optimistic about that. And I think part of that has to do with the idea that the wages didn't increase as much as expected. And everything for me is about inflation at the moment. If the wages aren't increasing, that means inflation might be being brought under control, which could potentially mean that we get a little bit of relief in terms of the U.S. interest rates. And you've already said it, that CPI number on Thursday out of the U.S. is going to be absolutely key. We're expecting consumer price inflation to drop to 6.5% from where it's sitting at 7.1% currently in the U.S. And we also expecting core, which is obviously stripping out energy and food prices, to drop from 6% down to 5.7%. And if we see inflation starting to moderate in the first half of 2023, I think this is going to be very, very positive for equity markets going forward.
Yeah, let's talk about oil for a moment. It's set to, I suppose, advancement in early trade. This as investors weigh on the outlook for China's demand recovery. We've already spoken about them opening their borders. Talk us through that.
So the idea that China will open its borders is incredibly positive. The free movement of goods and services within China and across Chinese borders is going to be a huge boost to the global economy, and with that you'd expect a higher demand for oil. At the same time, there's all sorts of other good news coming out of China, but we'll chat about that in a bit. But that very much is the demand side of the oil picture. Now, we have got oil prices ticking up, but part of this has also got to do with the supply side. Russia, obviously, we've seen Ukraine's Western allies putting in place price caps, saying that they won't buy Russian oil above $60 a barrel. But now we've seen a response by Russia saying that they could potentially cut their production by 5 to 7%. That takes between, call it 500,000 and 700,000 barrels per day out of the oil market. And that, again, is just constrained supply. If you've got a more constrained supply, that means that all those Western allies that are only prepared to buy at $60 a barrel, if there are output cuts, are going to have to go elsewhere. So you've got a very interesting situation developing in oil. And I think with the nerves, what you've seen is just the oil price ticking a little bit higher.
On the domestic front, the JSE is expected to rally as 10-cent rises, and China, again, we mentioned China aiming to end a tech crackdown. Your thoughts on these developments?
So certainly, I think at the end of the tech crackdown is going to be absolutely incredible, certainly for the local exchange. Now via the 10-cent holding and obviously the boost that we'll see in mass versus process, which will lift the top 40 index, and it'll probably lift a lot of viewers' pension funds as well. So very, very good news to see that tech crackdown ending. Now, this is part of, I suppose, a more broad-ranging reforms. We had one of the People's Bank of China officials coming out in a speech saying that they expected after the removal of many of the lockdown restrictions, for Chinese growth to return to very normal levels very quickly. Now, that spurred some optimism, but he also mentioned that he saw the tech crackdown ending, which has caused so much havoc in the likes of Baidu and Alibaba and of course Tencent as well. So with China now opening up and perhaps regulators getting a little bit more friendly, you might see nice returns out of the Chinese market, which is very, very cheap, as investors have had to digest the kind of risk premium they've got to adopt before investing there.
Yeah. Let's focus the attention on the local currency. Well, it's been under the spotlight with mixed forecasts on the local currency's performance for the year 2023. If you were to gaze at the crystal ball, Gary, talk us through the activity so far this year, along with the risks facing its emerging market peers.
So currency predictions are always incredibly difficult and generally very inaccurate. But if you look at it, the local currency normally does fairly well over the December period. It typically strengthens. There's a seasonal pattern there. I've seen that explained by the fact that many of our importers actually shut down over the Christmas period, but many of the exporters remain exporting. So that kind of creates a skew in the currency market where the rand gets a little bit stronger. We did see some strength. We saw the currency moving down to around 16.80 to the US dollar. That has recovered a little bit since then. We're currently trading about 7.08 to the US dollar. But as that unwinds, I think the risk factors for South Africa are still very, very prevalent. So for me, while we are, in purchasing power parity terms, very, very undervalued, we're undervalued because of the likes of, load shedding and the potential damage that can do to our economies. So I think there's certainly plenty of key risk factors that have been highlighted many times by the ratings agencies around our government debt, around Eskom, around growing public sector wage bills, etc. All of them remain key factors. I think at the moment the currency does look a little bit stronger than maybe you would expect. So I would expect a weakening over the year, but where it's going to go, do we end the year over 18 to the dollar? It's very difficult to say. A lot of this, I think, is also going to come down to what happens on the US side, the US dollar side of that equation, and that again relates back to the interest rates that we were talking about. Yeah,
let's talk company news, and you've already mentioned his name. The Ant Group founder, Jack Ma, set to give up control of the Chinese fintech giant. Have you seen the kind of reaction to this development so far?
Well, it's difficult to see where the reaction is going to be because you kind of want to understand. Remember Ant Group, his financial arm was going to list. We were going to see an IPO for Ant Group, and almost 2 years ago before Jack Ma went missing. Now to see how that can potentially come back to market, I think is going to be interesting. I think it's still very early days. At the moment, we know that Jack Ma's stake in that his stake in at least the voting shares of the company are going to be reduced to just over 6%, and that's going to help kind of almost stifle his control of the group. But with it, his other companies linked to him, the likes of Alibaba, have done absolutely outstandingly well in the last, say, 4 months. They've been under enormous pressure with the tech crackdowns. But we've seen, if you look at the ADR, which is the American depository receipt on Alibaba, that's moved from around 63 US dollars to 107 US dollars in the last 4 months. So you can see that there's definitely a recovery happening in these Chinese tech sector, these Chinese tech companies. And I don't know whether this, with the I suppose the dilution of Jack Ma's stake, this is just kind of almost drawing a line under the very heavy interference that we've seen from the Chinese government over the last 2 to 3 years.
Yeah. Finally, let's talk U.S. tech giant Salesforce, which is the latest to announce retrenchments after Meta, Twitter, and Amazon. Is this a taste of things to come in 2023?
Well, if you look at Salesforce, I mean, it's one that we cover. They're going to drop around 8,000 employees, which is about 10% of their workforce. But this is really in response to I suppose, how well they did over the pandemic. So Salesforce, obviously, it's the ERP systems that run so many companies and were so crucial to businesses functioning under the very odd situation that we had with COVID-19, where everyone was suddenly working from home but still had to communicate and manage their teams effectively. So what happened is they they went through a massive hiring spree, and they took on a lot of new employees through the COVID period, and now they're, with I suppose the world returning to normal, it's not that they're losing customers, but they've kind of overhired, if you want to put it that way. And what they're doing is they're trying to right-size their workforce, trying to become a little bit leaner, especially as the tech sector, just from a share price point of view, has come under pressure. And this is, for me, it's part of the natural business cycle where you go through almost a windfall growth period where you maybe grow a little bit too quickly, and then you go through a leaner period where you have to promote efficiency and almost trim down expenses. And this is one way that you can do it when you work in the U.S. and you don't have the kind of labor regulation that we have in South Africa.
Yeah, Gary Booysen, thank you very much for that markets update.